Here's something most people get backwards. The highest yielding NASDAQ ETF on the market right now, paying over 14% a year, has actually built less wealth than a fund paying 10%. That sounds wrong, I know, but I'm going to show you exactly why it's true, and it comes down to one number that most investors under 50 completely overlook. Today, we're breaking down two NASDAQ 100 ETFs that work completely differently from each other. One is built to maximize income, the other is built to maximize growth while still paying you every single month. And the smartest investors aren't choosing between them, they're using both. By the end of this video, you'll know exactly how each one works, which one actually builds more wealth over time, and how to combine them into a strategy that most people in their 30s and 40s haven't even heard of yet. And here's the part that might change how you think about dividend investing altogether. The fund with the bigger paycheck isn't the one making you richer. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. What these two ETFs actually do. Both of these funds give you exposure to the same thing, the NASDAQ 100. That's the 100 biggest non-financial companies on the NASDAQ. NVIDIA, Apple, Microsoft, Amazon, Meta, the companies that have driven most of the market's growth over the past few years. Same companies, same index, but these two funds generate income in completely different ways, and that's where everything changes. The first one is QQQI, built by a company called NEOS. Right now, it's sitting at about $13.1 billion in assets. It charges 0.68% in fees, and it pays roughly 14% a year distributed monthly. Now, how does it get that 14%? It uses options, but not on the individual stocks. It runs a multi-layer option strategy directly on the NASDAQ 100 index itself. They sell call options on the index for income, and they buy call options too, to keep some upside when the market rallies hard. Here's the part that matters most if you're investing in a taxable account. Those index options qualify as something called Section 1256 contracts. What that means in plain English, 60% of the gains get taxed at the lower long-term rate and 40% at the short-term rate, no matter how long you held them. For someone in a high tax bracket, that could mean paying about 26.8% instead of 37%. Big difference over decades. The second fund is GPIQ, built by Goldman Sachs. It holds about $5 billion in assets, and it charges just 0.29%, less than half what QQQI charges. GPIQ pays around 10.5% a year, also monthly. But here's what makes it different. It uses a dynamic overwrite strategy. Think of it like a dial. Goldman Sachs can sell call options on anywhere from 25% to 75% of the portfolio. When the market is running hot, they dial it down, maybe only covering 25 or 30%. That leaves 70% of your money riding the wave with no cap on the upside. When things get choppy and volatility spikes, they turn it up closer to 75% to collect bigger premiums. Right now, in this bull market, GPIQ's coverage has been sitting near 30%, and that's exactly why it's been the stronger growth engine of the two. So here's the simple version. QQQI, income first. GPIQ, growth first. Same index, two very different machines. Now let me show you what the numbers actually look like side by side. The numbers head-to-head. Let's put them next to each other and let the data do the talking. QQQI, expense ratio 0.68%, distribution rate about 14%, 1-year total return in the ballpark of 22 to 24%, since inception, annualized, roughly 20 to 21%. GPIQ, expense ratio 0.29%, distribution rate about 10.5%, 1-year total return closer to 29 to 32%, since inception, annualized, roughly 24%. So QQQI puts more cash in your pocket every single month, but GPIQ grows your total investment faster. And on fees alone, let me think about this. Over 10 years on a $10,000 investment, you'd pay about $680 in expenses with QQQI. With GPIQ, about $290. That's almost $400 more going to the fund company instead of compounding in your account. Now, here's the comparison most people never make. Both of these trail plain QQQ, the pure NASDAQ 100 index fund with no options, no income strategy. QQQ charges just 0.18% and has returned roughly 26% annualized over the same period. No monthly paycheck, just raw growth. That raises a real question. If QQQ beats them both, why would anyone choose QQQI or GPIQ? Good question. We're getting to that. But first, which one do you think builds more wealth over 20 years? The fund paying 14% or the fund paying 10.5%? Think about it for a second. The answer might genuinely surprise you. The myth that's costing you money. Here's the myth. Higher yield means your money grows faster. Sounds logical. More money coming in, more money to reinvest, faster growth, right? Here's the truth. When you're reinvesting your dividends, which is exactly what you should be doing if you're under 50 and building wealth, the only number that matters is total return. Yield is just one piece of total return. Growth is the other piece, and the piece that grows more wins. Let me show you why. Say you're 35. You put $10,000 into one of these funds today, and you reinvest every single distribution. After 20 years at 20% annualized total return, which is roughly QQQI's pace over the time it's existed, you'd end up with about $383,000. That same $10,000 at 24%, closer to what GPIQ has done, would grow to roughly $739,000, almost double. And at 26%, which is closer to what plain QQQ has returned, you'd be looking at about $1,020,000. Now, hold on, I need to be real with you. These growth rates are based on a bull market that won't last forever. Nobody should count on 20 to 26% returns for 20 straight years. That's not how this works. But the ranking tells you something important. The fund with the highest yield, 14%, had the lowest total return, and over time, that gap doesn't close. It widens dramatically. This is the #1 mistake I see under 50 investors make with covered call ETFs. They see 14% yield and think, that's better than 10, more cash coming in. But if you're reinvesting that cash anyway, it doesn't matter whether the return shows up as a dividend or as growth. A dollar is a dollar. What matters is the total. Smart investors building toward freedom don't chase yield, they chase total return. That's what compounds. Quick question before we move on. Are you more of a growth-first investor or an income-first investor right now? Drop it in the comments. I read every single one. The 2 ETF strategy. So, if QQQ beats both of them on total return, why even bother? Fair question. 3 reasons. First, monthly cash flow gives you options. Even if you're reinvesting everything right now, having real money hit your account every month means you can move. Market dips, you have cash to buy more. See a better opportunity? You can redeploy without selling anything. Cash flow is flexibility, and flexibility is underrated when you're building wealth. Second, lower volatility. Both QQQI and GPIQ had smaller drawdowns than QQQ during the tariff sell-off earlier this year. The option premiums act like a cushion. And here's the thing, if a 20% drop in QQQ would make you panic sell, these funds help you stay in the game. The best strategy in the world is worthless if you bail out at the bottom. Third, tax-efficient income in taxable accounts. QQQ is the most tax-efficient if you literally never sell. But if you want income before retirement, and a lot of people in their 30s and 40s do, QQQI and GPIQ deliver it with tax treatment that most income funds can't match. QQQI's Section 1256 treatment, GPIQ's return of capital, about 97% of its distributions have been classified as ROC, which means you're not paying tax when you receive it. You pay later at capital gains rates when you sell. So here's the play. Don't think of it as QQQI versus GPIQ. Think of it as QQQI plus GPIQ.
GPIQ is your growth engine. Lower fees, more upside capture in rallies. Let it run.
QQQI is your income engine. Higher yield, better tax treatment on the distributions. Set it to DRIP, that's automatic dividend reinvestment, and let that 14% compound. Together, you get growth you won't get from QQQI alone, and income you won't get from GPIQ alone. 2 jobs, 2 ETFs, 1 strategy. Now, and this part gets missed a lot, where you hold these matters just as much as which ones you buy. Put the wrong fund in the wrong account, and you're handing money to the IRS that should be compounding in your portfolio. Here's the playbook. Roth IRA, best home for QQQI. That 14% yield grows and compounds completely tax-free. You never pay a dime on those distributions. Not now, not in 30 years. Set it to DRIP and don't touch it.
Taxable brokerage, GPIQ fits well here. That 97% return of capital treatment means you're deferring the tax until you sell. And when you do sell, it's at capital gains rates, not ordinary income. That's a powerful tool over decades. And if you want pure growth with maximum tax efficiency in a taxable account, QQQ or QQQM is still the cleanest option. Almost no distributions, almost no tax drag, just compounding. The smart move for an investor under 50? Think about using all 3. QQQ or QQQM as your growth core, QQQI plus GPIQ as a satellite, maybe 10 to 30% of your NASDAQ allocation for income, flexibility, and smoother rides during corrections. If you could only pick one of these for your Roth IRA and hold it for 20 years, would you go QQQI for the massive yield or GPIQ for the better total return? There's no wrong answer here, but your answer tells you a lot about what kind of investor you are. One more thing before we wrap up, and this is important. Both of these funds are less than 3 years old. They've only existed in a bull market. We have not seen how they perform through a real prolonged downturn. Covered call funds typically do better in flat and down markets than pure index funds, so the fact that they're trailing QQQ right now is expected in a strong rally. That ranking could flip in a different market. The key is knowing what you own and why you own it. Don't chase yield, chase total return. That's what compounds. If someone you know is investing in NASDAQ ETFs and hasn't heard of QQQI or GPIQ yet, share this video with them right now. It could change how they think about building wealth. Are you already using covered call ETFs in your portfolio, or is this the first time you've looked at them? Let me know in the comments. I want to hear where you're at. If you're building wealth from your investments and want to stay ahead of strategies like this, subscribe to this channel and hit that bell so you never miss a new video.